Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Graham Car Carriers. Please note, you can submit questions in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome George Wist, Chief Executive Officer of Graham Car Carriers ASA, which trades on the OTCQX Best Market under the symbol GCCRF and on the Oslo Bourse under the symbol GCC. Welcome, George.
Thank you very much, and welcome everyone. My name is George Wist, and I'm the CEO of Graham Car Carriers. We're very pleased to meet here and to present at the Small Cap Growth Virtual Investor Conference. Graham Car Carriers, we're the third largest shipping tonnage provider in the car carrier space. We own and operate vessels on long-term contract with some of the biggest names within the global auto industry. We're listed on Euronext Oslo Børs main board since December last year and on the Euronext Growth since January last year. And now since June, we are on the OTCQX trading under the ticker GCCRF. So what makes Graham Car Carriers an attractive investment opportunity? Well, we are a unique pure play investment opportunity within the car shipping and logistics space. We're currently experiencing very attractive market fundamentals, and we are capturing this strong market through long-term contracts and value-adding vessel transactions. We have very good visibility on growing earnings and cash generation. And we have a strong commitment to deliver attractive dividends to our shareholders on a quarterly basis. Graham Car Carriers, we're a strong industry name. We have more than 40 years engagement in the car shipping market. We have extensive experience from chartering our vessels to all major global operators, as well as key regional operators worldwide. These operators hold large volume contracts to carry vehicles for all the global brands such as Tesla, Ford, Volkswagen, General Motors, and so on. We're headquartered in Oslo in Norway, and together with our Singapore office, we manage a very modern fleet of car carriers. We have three main types of vessels. We have the distribution vessels serving regional markets like Northern Europe and the Caribbean, and from Mexico up to the US. We have mid-sized vessels serving north-south trade lanes and intracontinents. And we have the Panamax vessels serving the east-west trade lanes, crossing the canals and the major oceans. We also operate on commercial management for new buildings for global auto carriers. The car industry is one of the world's largest industries, and we are an integral part of their logistic chain. We charter our vessels to the operators, who in turn sits on volume contracts with the car manufacturers. Let's take some examples. You have Glovis, part of the Hyundai Group. They operate about 90 vessels. They only own 30 of these themselves. The balancing 60 they chartering from tonnage providers like us. Then you have the Japanese, NYK, MOL, K-Line. They operate about 100 ships each. About 1/3 of that they charter in from tonnage providers, 2/3 they own themselves. On the other side of the spectrum, you have Wallenius Wilhelmsen. They operate about 130 ships, but only charter in about 10%. The rest they own themselves. So Graham Car Carriers, we are a preferred partner who deliver a consistently high quality service, which means all stringent quality measures set by the car manufacturers. Since listing, we had a clear commitment to provide attractive shareholder distributions, and we have delivered on this. So far, we have distributed $32.1 million in total since joining Euronext Growth in January last year. For Q2, we paid 47 cents per share in dividends, which represents the 6th consecutive quarter increased dividends. This is reflecting increased earnings and payout ratio, which now stands at 75% of net income and is in line with our new dividend policy of distributing 75% of net income on a quarterly basis. We distribute our capital in a tax-efficient manner by way of repayment of paid-in capital. Analyzed Q2 distribution implies a 12% dividend yield. Dividend is set to increase as a function of the earnings locked in through our contract backlog. And the analyst consensus indicate about a 20% dividend yield at current share price for 2024 and 2025. We're currently covered by 7 analysts, and they all have a buy rating on our company. The current analyst consensus target is a share price between 240 and 250 per share, which is about $22 per share, up 25% from where it's trading today. Contact details for all our analysts you can find on the Gram Car Carrier webpage, gramcar.com. End user demand for cars is increasing, with the market expected to be back at pre-COVID levels in 2024. Still, end user demand has a way to go before we're back at the levels we saw in 2017 and 2018. And we see a continued shortage of vessels. Charter rates have now stabilized at a record high level. So what's really driving the car carrier market? And if there's one slide and one simple explanation I would like you to take away with you from this presentation is this slide. Increased ton-mile demand with rapidly growing export from Asia to the world. Asian vehicle producers, led by China, but supported by South Korea and Japan, are set to grow their export by an estimated 41% in 2023 compared to pre-COVID in 2019. And that is with virtually no fleet growth. So what happens when you have 41% growth and you have no fleet growth? You get a magically fantastic market. They're taking market share, the Asian operators, and out-competing European seaborne export, driving up average sailing distances. The increase from 2019 to 2023 is 3.9 million cars export from Asia to the world markets. And if you translate into how many ships that requires an additional 100 Panamax vessels, which is the largest type that carry cars. More than 50% of expected 2023 exports from Asia are heading to North America and to Europe. This is driving up ton-mile demand and explains the current very tight market. So the shift led by Chinese export is getting a lot of attention these days, and you can now read more and more about exports from China, the car carrier market, and everything in popular press. Even the Financial Times have quite a number of articles these days. So let's take a closer look at China. China has rapidly established themselves as the second largest and very soon will be the largest car exporter in the world. The current export run rate indicates more than 4.5 million cars annually, up from 3.25 million vehicles shipped last year. And the EV share last 12 months stand at 31%. China is expanding its position as a global EV powerhouse, and this will further drive ton-mile demand and growth. Driven by both Chinese car brands growing internationally and international car brands such as Tesla, followed by Volkswagen, BMW, Volvo, and General Motors are investing in production in China. They're benefiting from an established battery electric value chain. They have modern production facilities, modern port infrastructure, and a well-established auto parts supply chain, including EV batteries. And they do have a large, skilled, and cost-efficient workforce. There's a clear shortage of car shipping capacity in today's market. What we've done here is that we matched all the satellite AAS data. So we tracked all the car carriers departing from Asian ports. That's the top line. We matched that with the customs data for exports for cars, used cars, high and heavy cargo, everything. And the deficit is around 1,250,000 units so far this year. To get these cars to the market, the manufacturers has to utilize inefficient transport methods at the moment, such as container boxes, dry cargo vessels with racks, and even on multi-purpose vessels. These suboptimal solutions are predominantly used to carry used cars from Japan and Korea, and also a low single-digit, double-digit percentage from China. So closing this gap, we need an additional 40 car carriers. With this in mind, we expect the order book for new vessels to be absorbed. We have negative fleet growth and capacity deficit due to underinvestment in recent years. We have an environmental regulation which will force the global fleet to slow down and reduce capacity further. There are also a number of vessels that will be recycled due to age and environmental regulation. And lastly, trade growth is set to continue to be driven by long-haul trades from China and Asia to the world. In this historically strong market, we have built a very robust contract backlog. With the latest contracts, we only have one mid-sized vessel left, Viking Amber, coming open next year. Otherwise, we are effectively sold out through entire 2025. We expect a continued strong car shipping market lasting well beyond that. As you can see, we have vessels rolling over on new contracts with higher earnings into 2024, driving growth in revenue and earnings. All this considered, we have an exceptionally visibility on cash generation, which I will get back to on the next slide. Our revenue backlog is at a record. It now exceeds $900 million of fixed revenue backlog. This is as of end of September numbers, and it also includes the recently announced Viking Queen contract. The graph to the right shows the split on year of expected revenue recognition and demonstrates the good visibility we have on future earnings. It reflects our focus on longer charters with quality operators providing good visibility on cash flow and dividends to shareholders. So, what does this mean for Gram Car Carriers and our shareholders? We're well positioned to create significant value, and this is supported by historic high revenue backlog with long-term contracts. Our average duration is 3.2 years for the mid-size, 4.8 years for the Panamax vessels. It is a robust cash flow visibility, and we are committed to attractive dividend distributions, distributing 75% of net profit on a quarterly basis. I thank you all for listening, and we will now open the floor for questions.
Good.
I have
Morning.
together with I have Mats Gram, our head of IR, who will take your.
Hello. Oh, good morning, everyone. We have received a couple of questions that I will pass on to Georg. And the first one is, how do you manage fluctuations in fuel costs? Are there any alternative green ships in the future? And it seems that we might having a little reconnection problem here with Georg. We will just try and wait a second before he comes back on.
Hello? Are we back? Mats, are we back?
Yes, you're back on.
Very
I don't
good.
know if you heard my question, but I can repeat it. How do you manage fluctuations in fuel costs? Are there any alternative green ships in the future?
Yeah, so we are a time charter provider, so which means that we charter our ship out to the operators, and the fuel cost is for their account. So we don't have any fuel through our P&L or any risk on the fuel. And there was one question on green.
Yes. Are there any alternative for green ships in the future?
Yeah, so we're at a quite interesting point of time at the moment. So the industry is trying to figure out what is next. So there is the car carrier fleet is probably in the forefront. So almost all the new building orders are for dual fuel LNG, which will cut carbon emissions. There's also carbon capture projects going on, and also some are also looking into the possibility of using ammonia as fuel for the next generation. So there's a lot of green projects, and it's probably driven by the fact that the end user, the consumers, want to know the carbon footprint of the car they're buying. So a lot of focus on this, and our cargo is very traceable through the value chain.
Very good. I got another one here. You recently sold Constanza and Princess, making a US dollar 19 million profit. Will this also be distributed for with 75%? And if so, when?
Yeah, so basically that is correct. We sold 2 vessels. One we will deliver to the new owners in 2 weeks' time. So that will be a Q4 event. So we expect to distribute the 75% of the profit for that vessel, which is the lion's share of it, about 36 million. We're selling for, and then you net off the book value, etc. So we're looking to do the lion's share of that distribution with the Q4 distribution. And then the older, smaller ship will get sold in Q1, so that will come with the Q1 distribution.
Very good. And then we have a few questions regarding the different risks we are facing. The first one is, how are you impacted by the auto workers strike in the US?
Yeah, so that's quite an interesting question, which we follow quite closely. But a lot of the sort of the made in US, sold in US are mostly affected by this. The more the EVs and the other are more produced in the southern states, which doesn't have a lot of the strikes. But what we are seeing is that the share of import to the United States, which is about 20 to 25% of all cars sold, are imported, and we see quite strong shipping figures from Asian markets, both from Japan, Korea, and China, and also from Europe into the United States at the moment.
Very good. And then the other on the risk is, how do you see the impact from the EU probe on Chinese-built EVs?
Yeah, that is quite interesting. This is von der Leyen's statement. She was out wanting to do a review and see if Chinese are subsidizing their EV export. Well, first of all, the EV export out of China, as we just talked about, is about 30%. So 70% is internal combustion engine vehicles. So that is not part of what she's looking after. Of the 30% that is going, half of that is Tesla, and I doubt whether or not that is the intention, is to go after Tesla. You also have some GM products, Volvo, and other brands. So it's less than you think, and also quite interestingly, the sticker price for a Chinese sold car in Europe is 30% higher for what they sell for in the domestic market, where I personally struggle to see how that can be considered as a subsidy when they're able to extract a 30% higher profit margins in overseas market. But it's she's obviously under a lot of pressure from the auto workers in Europe, and the jury is still out. But I think it's not going to be that have that much effect on our business.
Very good. And the last one on the risk side is, what are the biggest risks to your dividend streams in 2024?
We are pretty much, we have one more ship to fix, and we are in discussions there. You should expect some news there over the next weeks and month, maybe. And then we're sold out. So then it's about operations. What can alter it will be if we have a breakdown on one of our ships, but otherwise it's really simple to calculate your dividend checks here. You just do the math. You take the charter rates, you subtract about $8,000. You subtract the cash flow break even number of about $17,000 per day, and take 75% of that, and that will be your dividend check. So solid counterparts. All the tire value chain is making money, so it's very difficult to see what can really go wrong. I mean, the vessels are well insured and the contract, so I struggle to see what can really jeopardize the dividend.
Very good. And the next one is, can we expect any more new building orders from GCC?
Well, we haven't made any new building orders, and by design, what we have done, we're all about dividends, we're all about vessels on the waters and cash flow. So we were the initiator of global auto carriers, and we recycled a fee for putting that together. So we have a 1% ownership there. We have a 7% warrant that we can exercise when and if we want. The idea is more to, once those ships are fixed and we get closer to delivery, then we will of course have a discussion and see if we can make a combination. And we will only do that if it's neutral or accretive to our earnings per share. So this also demonstrates our extreme discipline when it comes to capital. We will only buy ships, old or new, if it creates value for our shareholders. We will not do that and at prices and then deals that are dilutive to existing shareholders.
Very good. The next one is, what's the yard price for a Panamax new building today?
Well, it depends a bit on which propulsion you go after. If you go after what most people are ordering now, and the most popular size now is a 7,000 dual fuel LNG. And if you go out and order one today, you're going to be in the low to mid 90s in China. You're going to look at 220, 230 in Korea, and Japan. It's not open for foreigners. They're all building for the Japanese. So I wouldn't like to speculate there. So it's literally Korea and China. China is by far the biggest.
Very good. And then we have a question on the capital stack. With the 75% dividend policy, when will you be debt free?
Yeah, so according to the analysts, because I cannot guide on the future, but according to the analysts which have done the math, and I do understand the numbers, we will be net debt free sometime in 2027, early 2027. So well before all our contracts expire.
Okay, and the next one here, are there any plans for further share buybacks?
Well, we have done a little bit of share buyback, but it's really to cover employee incentive programs, and we can also use them to buy assets as well. So we have the flexibility there, but it's a chicken and egg. It's a bit difficult situation because at one stage we would like to have great liquidity, and if we buy back too much, then that dries up liquidity. So in a perfect world with perfect liquidity, we will be looking to buy back. So I think we'll look at it opportunistically, depending on what's out there. But in general, we'd like now to build more liquidity in the stock to make sure that increases to the advantage of the shareholders.
Very good. We have time for some more questions. Yes, we do. Which are the biggest risks for the business model? Is competition aggressive, and how can we be sure that supply demand is in balance going forward?
Yeah, so basically, obviously there are other competitors in the tonnage provider space, and the competition is sound from that perspective. I think what we are seeing that whenever we have one position open, there is at least 2 to 3, sometimes even more people who want to try to get hold of that ship. We normally try to engage and renew with the existing client, but obviously they have to pay market, and in case they are not willing to do that or they lose some of their volumes, then at the moment there is ample demand for car carriers. As I hope you got from one of my slides, there is at least 35 to 40 ships too little. That's why we're now seeing inefficient solutions that cars are carried in container boxes and even dry cargo vessels and high and heavy vessels. So it looks very, very tight and very balanced for the next couple of years.
Very good. That actually seems to be the last of the received questions. So unless nobody of the audience wants to call in or write in new questions, I think that marks the end of the presentation. Do you have any last few words, Georg, that you would like to say?
No, I mean, key takeaways, which I hope is clear, is that it's the one slide I showed you, which talks about the 41% growth out of Asia to the world. That's really explaining the tight market we're seeing at the moment. If you just look at the entire world trade, then you will miss this little finesse here. But that's what sets the market. I think we are, very capital disciplined, and we are paying 75% of our profit in dividends. And it's as I've said on another conference, we're kind of a boring company. We will just keep on paying these checks, and we are extremely predictable. So if you like predictability, you like 20% dividend yield, and no big surprises, then you should take a look at our stock. And we are going to stick around. So if any of the listeners or others wants to book one-on-one meetings, we still have a few openings. So please feel free to reach out and book one-on-ones through the platform.
Okay, thank you very much. Then I think this will end the webinar, and we thank all listeners for joining in, and hope everyone has learned a bit more about our company.
Thanks, everyone.